Do like to start off the week with a summary of what we saw happening in the market. And the first thing we're going to discuss today is really just our signals. We started kind of displaying these last week. And as you recall, we kind of have this green, yellow, red concept where we have two different ones, a fast trigger. So when things are moving, quicker with more transactions, something we might use for an IRA or a Roth IRA because we don't have to account for those transactions, versus something slower like a taxable account. And so today our fast trigger actually went red. And so we have red for fast and slow on the stock side, and then the bond side is still green. So we'll be making some changes on Monday. And really for us, when something goes red, it means we move more money away from the stock market towards the T-bill type ETF market, just as a preservation situation. May not be there for long, but just something that we do just to be careful as far as that goes. We'll talk about kind of why these triggers are happening potentially, but overall that's what's going on, in terms of our triggers. And you'll see those come across the bottom of the screen here throughout the show, so you can kind of tell what we're doing. So this is the chart for the S&P 500 going back to the beginning of last year. That was the all-time high, the 4th of January. We had all of these roller coaster rides on the way down. Finally this year we broke through that trend line. We set a new high. And then so far later on in this year, in this first quarter, we've actually come back down to that trend line, bounced off of it again. And so, the question remains at the moment so far, if you look at the kind of checklist of everything you'd want to see a reversal of direction. So we're going from this downturn primary motion to a primary upturn. We've checked off a lot of pieces, but not all of them. And so that's the issue right now. The low that we had was in October. That was a while ago. We've had a nice little kind of run here and really kind of been going sideways for a while if you look at this pretty closely. And so there's a big battle going on in the market between, the people that believe that things are already as low as they're going to go and other people that feel like it's going to go a lot lower. And so we're kind of, in this, I guess, zone right now of balance between those two pieces. And if we look at what happened this week, here's a 5-minute chart. We've had what looks like a down week. We'll see how this today finishes. We might end up with a slightly up week, but we're right in that kind of neighborhood. We had a very good beginning prior to the Federal Reserve meeting, right? We had a nice run up. It was really strong, actually. And then the Federal Reserve meeting, they came out and said that they were increasing rates by a quarter point. And you can see that big drop off was at the very end of that day. And the quarter point, I don't think, was a big problem. There was a couple things that happened that day that were issues. Number one, the Federal Reserve chairman was asked about interest rates for the rest of the year. So that Fed puts out this thing called the Statement of Economic Projections. They put it out 4 times a year. The last one is in December. And what they're saying is, what's their expectation for where rates are going to go? And so they said 5.1% peak rate, which is about 1/4% higher than we are right now. So they're saying we're going to have one more rate increase, and then we're not going to have anything else for the year, right? But the market, and one of the questions that was brought up is the market is looking at that rate coming back down later on this year. And they asked Powell, I said, what do you think of that? And he says, well, we don't see rates coming back down at the end of the year. And so the market responded negatively to that. And then at the very end of the day, there was some more chatter about the banking scenario.
Yeah, what could the market infer with the federal funds rate being kind of sticky? Are they saying that inflation is going to stick around longer than the market expects? Or
Well,
is it kind of
the market, in my opinion, is really looking at a decrease of rates after this 5% peak rate. And so a decrease would be because of a recession. So they're expecting the things to slow down enough where the Federal Reserve in the second half of this year would have to lower rates. And the big change in that thought process is the banking situation. And one of the things that Powell talked about during the meeting was that the banking situation will tighten up credit. So they won't be lending as freely as they might have been because they need the money for their own capital reserves. And that's effectively another way of kind of trying to slow down the economy. So they don't really have to raise rates that much. because the banking situation's going to slow things down for them. But the market, if you look at the futures market, which we'll look at here in a moment, is essentially looking at it and saying, well, yeah, but this banking situation could create these other, cascading problems, and all of a sudden the Fed's going to have to be responding by lowering rates. And so, we'll see what happens there. But it's a good question. Here's the Fed funds rate going back to 1955. I just find this kind of fascinating because, first of all, we're not that high right now, obviously. We're below 5%, which historically is less than average. However, you can see how steep it is. The angle of that incline here, right, so the last little run right over Easton's head there is what's been going on here. We came out from 0 up to, almost 5%. The last time we had anything close to this was the beginning of 2008. And I'll tell you what, I guarantee, if the market is having some troubles, it has a lot to do with thinking about 2008 and the things that happened then, and maybe even what happened in 1970s with this massive increase of inflation. And we got the Fed funds rate got up to 19%, which is kind of mind-boggling, really, when you think about it. We've had so many moves here, and we're still only at little less than 5. But so I think that's kind of interesting, just in the, putting that in a historical perspective. I think the thing that I really liked about the meeting from the Federal Reserve was the fact that they said there was one more rate increase and then they would pause. I think the market's going to like that in the end, assuming something doesn't fall apart on the recession side or something doesn't break. The market's going to like when they start to really pause, and that could be very positive for the market. But one of the things that, and this is kind of to answer your question, Easton, this is the Fed funds futures market, basically guessing where the Fed fund will be at some point in the future. So this is in January of next year. And you could see that it actually was way up there, nearly 6%, 5 and 3/4-ish, right? Yep. And then whoosh, it came straight down. And so the expectation changed because of the banking. When Silicon Valley Bank had its, closure, that started that downturn. And so what that did is kind of woke up the market to say, hey, there's an issue. It's probably not just this one bank. And lo and behold, of course, it was Signature Bank and First Republic and,
Yeah, the cracks are forming.
Yeah, and the Credit Suisse. And so it's not even here just in the U.S. because all banks are investing in bonds. And in very simple terms, what's happening is they're buying these bonds. The bonds, they have a capital requirement that might be up here. And so the bonds are okay. And then when the bond value comes down, right, all of a sudden they got this gap. Right? So the capital requirement, they've still got to fill that gap. So they'll fill that gap by lending less money. That's what Fed's happy about that. But sometimes they can't do that. They need capital. And that's what actually started the Silicon Valley Bank scenario. They were going to do an offering of stock, and that just alerted everybody. And then they had a kind of a bank run.
Yeah, and the crazy part is now with bank runs is it's all electronic, so you can move your money in minutes. It's not like you have to wait in line.
It's a real issue for the banks, I'm telling you, because literally in minutes a bank could be out of money because of that. Now there is FDIC insurance. There is this big $1 trillion pool that the U.S. has put out there to backstop even past 250,000, which is what they did for Silicon Valley and for Signature Bank, for example. It used to be you had to take your passbook down and go stand in line, like the pictures we see from the Great Depression. Now it's just done electronically. So, but this was one of the consternations for the market this week, was just the fact that the market is expecting the Fed to lower rates at some point in the future here at the end of this year, back down to 4%. And the Fed chairman says, hey, we're looking at not lowering that. Now, the problem for the Fed is they said that they weren't going to raise rates in September of 21. They said no rate increases in 2022. Well, you just saw the chart. It was actually quite steep. Yep. A lot of rate increases. They said prior to that we don't need to raise rates because inflation is temporary, right? Transitionary. And that didn't turn out to be good. And so they waited too long, and so that's an issue. And so that's where the Federal Reserve has a credibility gap, and the market is saying you're going to drop your rates, and they're saying they aren't. The market has been more accurate as to where rates actually end up. The problem is the Fed can continue to do maybe what they shouldn't do, and that's where things can break down, right? And so that's what's scary. When they say something that contrary to what the market believes should happen, things kind of break down, at least temporarily, until they get more in line with what the market is thinking needs to happen. So anyway, that's what's going on in that segment. So it's kind of two things this week is just, what's happening with the Fed, because we had the Fed meeting, and what's happening in the banking system, which has definitely gotten better, but there's still pieces going on. And here's the thing that came up during the meeting also. They asked Chairman Powell, hey, what do you think about the banks, right? And he's like, well, the banks that have had trouble so far were kind of in unique situations. They've made mistakes. They've gotten too far out on the bond ladder. They had lent too much money out to risky investments. Their particular clients were, like hedge funds and things that were unusual for the Silicon Valley Bank, et cetera, et cetera. And it brings up the thought process that in 2007, Bernanke was testifying. He was the current, Fed chairman in front of Congress, and they asked him about subprime mortgages. And he said, oh, I don't think those are going to be a big problem. And of course they were. And so sometimes it's hard for anybody to see the connections that happen. But this chart that I'm showing you here is the amount of money that's being borrowed by banks from the Federal Reserve for what they're called their liquidity facilities. And there's all kinds of lines on here, but the blue line is the total. So this is the last 6 months. All of a sudden, 2 weeks ago, 154 billion was borrowed. That's a lot more than normal. And it did drop, and Powell mentioned about the drop, but it was still, still looking at over $100 billion still borrowed, right? So if there's no banking problem, why is there such a big jump in borrowing going on, right? So those are the things that the market is looking at. Okay, this is what the Fed is saying, and this is what we see happening. And I think one of the reasons we're getting our triggers to kind of these red triggers that are coming up is because there's things happening behind the scenes that we don't really know about, right? We didn't know about Silicon Valley Bank. The market had already started down before that, right? Other people know about Silicon Valley Bank. And so my big emphasis is always to kind of focus on, the price, look at what's happening with the market. And we're having some decent times, but whenever we get a chance to really run, it's kind of lopped off. Right? And it's just not enough strength and really kind of going sideways. But we need to see motion forward here to get out of this, and we're not seeing that. So there's the possibility of motion backwards or going down too. So to put this chart into perspective, though, if we take this back, this is just 6 months. So the last 6 months, big hike. But if I go back all the way to before 2008 on this chart, you can see that right over, between Easton and I here is that little bump we were just looking at. Doesn't look nearly as ominous as it did 2020, big jump, and then of course 2008. Oh my gosh, yeah, a lot of money being borrowed. So
yeah, it's pretty similar to 2012. That little
it is.
bump.
It's a lot more like 2012, and it probably is a lot more like 2012 because the one thing that we have that's different than 2008 is the fact that we have this pent-up demand. We have consumers spending money. I mean, they're out there spending money, and they're driving this thing. Now, that creates some inflation. It creates some other problems, but you can't have high inflation and a big, giant recession. They don't go together. So at the moment, big concern about giant recession, big concern about spending too much money, they're kind of equaling out. And that's why the market's kind of going sideways also. So there is things that are happening that are kind of interesting. However, there's more and more things pulling on those consumers to make it harder for them to spend, because of the interest rate increases. So they're borrowing on their credit cards. That's going to cost more, as they raise rates and those types of things. So I think it's a period of time to, be a little cautious, not too worried about things, but we're definitely going to be adding some T-bills to the accounts on Monday. Assuming, Monday isn't a big giant up day, we follow a little system day by day to see when we should do these things. But that we got the signal, so now we're basically on watch to see what happens. So, all right, well, that's our summary for this week. Great that you could join us. Look forward to kind of doing a summary again next week, too.